Christoph is going to present on the political economy of Chinese sovereign and infrastructure lending. So over to you, Christoph.
Well, thank you very much for the kind invitation. It's great to be here. I'm going to talk about China's vast overseas lending program, which has led to some of the most profound changes in international finance in developing countries in several decades. It has really shook the status quo on what we thought we knew about sovereign debt, about international sovereign debt markets. As many of you know, China has extended record amounts of lending to Belt and Road as part of its Belt and Road initiative, most of it being for infrastructure, for energy projects, and pretty much all of it being state-driven. So these are state banks, state companies that are investing and lending abroad. Overall, it's estimated that total lending to the developing world exceeds 1 trillion, so this is really a very large program. The big challenge in studying, this overseas lending program is that it is very opaque. China is treating its overseas lending as a state secret, and we can't rely on our usual data sets when it comes to identifying these loans. So China is not part of the OECD, it's not part of the Paris Club of Western government lenders. We can't go to the rating agencies because they don't track state lending. They focus on private investing flows. And we can also not rely on, say, Bloomberg, Dealogic. So all our usual sources are just not there. In other words, we are really, we had a country that has massively expanded its footprint in international finance, and this has created a large knowledge gap. So we were really not knowing what was happening. And over the past 10 years, so we don't know the size of this, we don't know the destination of it, and we don't know the terms and characteristics of this lending. And over the past 10 years, we have been working on closing these knowledge gap, helping to add knowledge on this program, which really implied a lot of detective work in trying to figure out both the lending boom and the lending bust that has followed. So the roadmap for today is that I will put the China's lending boom in historical perspective, and then I'm going to emphasize 5 key features of Chinese lending boom that are particularly salient politically, because that was the suggestion for my talk. So the big picture is that this is very much a sovereign lending or emerging market lending boom and bust that we have seen many times before in history. Think about the 1970s lending boom to developing countries, which was driven by Western banks. It was also targeted towards poor countries that are commodity rich. There was lots of optimism that these countries would, develop and that these loans would pay off. Eventually, in the 80s, we all know how that ended. The developing country debt crisis began in 1982 and lasted for more than a decade. And China's lending boom to developing countries today, or the past 20 years, shares many of these attributes. In fact, it's part of a much longer history. So this is the boom. This is China's rise. And what is astonishing is just within 20 years, China became the largest official creditor in the world, surpassing even the portfolio of the World Bank. I can tell you, constructing this red line took us 2 years. Why? Because you needed to puzzle together all these individual loans, compare them across sources, build this consensus data set on all these individual loans to actually figure out how much China had been lending and how much countries were owing towards China, right? And once we've done it, we realized just how big this lending program had become, surpassing not just the World Bank, but also all the portfolio of all of the Western government lenders put together, and of the IMF. So this has been quite an astonishing development in a very short period of time. As so many booms in history, it's a boom that has ended in a bust. Many of the countries that China has lent to are now in debt distress, have problems repaying these loans that are often shorter terms, 7-year maturity, relatively high interest rates, many strings attached. So this is debt that is hard to pay back. And in fact, the net transfer, this is what this graph shows, the net transfer from China to the developing world has turned negative in 2019, meaning that the developing world is paying back more principal, more interest than what China is putting up in new commitment and new loan commitments, right? So this is a remarkable lending reversal. Much of 70% of this lending is infrastructure, and again, this is nothing new. Great powers, especially rising powers, have had a history of infrastructure lending. I think of the large empire, UK empire lending to developing countries, but also the German Reich's Berlin-Baghdad Railway. The Marshall Plan had a very large infrastructure component. So none of that is particularly new. In fact, when we look at, this is from a paper with Carmen and Sebastian Reinhardt, where we trace sovereign to sovereign lending, so official lending over 200 years. And what you can see is that, this is the share of all sovereign loans given out to developing countries and other countries. And what you can see is that, up till the mid-20th century, it's really the Europe that dominates official lending. Then the United States comes in, the Soviet Union. In more recent decades is Japan, and now China, right? So the rising powers of the day are also the biggest lenders, and much of this was infrastructure, right? So none of this is particularly, this is part of a long history. But let me, for the rest of the talk, emphasize 5 features of this lending program that are noteworthy, that stand out. And to me, as a sovereign debt researcher, it was really this was a fascinating journey in that, many of these features are very innovative. China has shown, to be commercially savvy about this. It has, tried to overcome long-standing enforcement problems that we all know in sovereign debt markets, commitment problems, repayment problems. And China is experimenting, and to some degree, the jury is still out, but to some degree, it has succeeded in really innovating and shaking, some of the foundations in international sovereign lending. The first salient feature is secrecy. And it's secrecy by design. I mentioned that China is not releasing data on the destination, the characteristics and the detailed terms of these loans, but it also wants the receiving countries not to share any information, right? So the contracts that China has been given out, and much of this is based on 100 original contracts that we were able to get our hands on to really understand the structure of these loans, so we could evaluate the original agreements. And what these agreements contain are very broad confidentiality clauses. So this is a typical Exim Bank. So most of the lending in the first 15 years was driven by 2 big banks, Exim Bank and CDB, China Development Banks. So what's an classic Exim Bank loan will be widely distributed across the whole portfolio. And what you can see is that these are very strong secrecy clauses. So the borrower shall keep all terms strictly confidential, not disclose any information, not even about the existence of the loan, right, to any third party unless required by applicable law. So unless a country unless Parliament forces the sovereign to release this information, this is not, debtor countries are prohibited to disclose any details to its own population on, what kind of deals it is engaging with China here. And that's quite remarkable. What's the result of this secrecy? Well, we missed a lot of the lending flows, but we also missed a lot of the repayment problems, so the defaults that were going on. And in our most recent papers, we uncover that China has, built up a system of financial rescue operations, of bailouts that, also took place largely out of public sight, right? So just give me much of what I'm going to do here are kind of the highlights of this 10-year research agenda, right? I'm happy to go in detail in the Q&A on each of these points that might be of interest to you. But this is from our first paper. Once we had puzzled together all the lending from these various sources, created our consensus database, we benchmarked it against kind of the gold standard in international sovereign debt statistics, which is the World Bank's IDS. And we found that the IDS, the World Bank, had missed 50% of all of the Chinese flows. So these are several $100 billion that were just not registered in the standard databases that all of us policymakers, academics had been using, right? So we termed this the problem of hidden debt. It was very controversial. Now it's kind of more established, a little bit like your point. So hidden debts are now widely recognized as a problem, and indeed they were large. Many of these coverage problems have been solved by now, but China, this is a cat and mouse game, and China is now, using more offshore, using more shell companies to hide some of this lending. So it's an ongoing challenge and an ongoing surveillance gap that we're dealing with here. This is what we knew about sovereign defaults from the rating agency. So each bar represents a debt restructuring in a developing country with bondholders or private commercial external commercial banks, right? You look at this graph and you think emerging markets are in pretty good shape. There's relatively few defaults in the recent 20 years or so. But once you account for what we call hidden defaults, right? The restructuring vis-a-vis Chinese creditors, the picture looks very different. So developing countries have engaged in more than 100 restructuring operations with developing countries over the past 20 years. We look at the details of this, but this is a very important aspect of international finance and of sovereign debt. And much of the action was simply not in public sight. This is the second main result of this secrecy. A third was that China has emerged as an international lender of last resort. Again, we had anecdotes of this in the Wall Street Journal, individual case studies, think tanks, but the scope of China's overseas rescue operations, of overseas bailouts, wasn't known. So we put together a data set of these bailouts, and it turns out that over the past 20 years, total bailouts of Chinese entities, including the swap lines, we can talk about it, in the Q&A, swap line lending, which are effectively financial bailouts, plus balance of payment and budget support in crisis situations amounts to 240 billion. That's about 20%. Yes.
Just clarification.
Yeah, sure.
This is the state bailing out Chinese banks or China bailing out the ultimate borrower?
The ultimate borrower. So this is bailout operations on the Belt and Road, if you want, right?
Got it. Thanks.
Almost entirely targeted to Belt and Road debtor countries that are typically the larger ones that face distress, that face payment problems. They are bailed out by Chinese banks and by the Chinese central bank to keep afloat. That's essentially here. So and the amount of this lending accounted for 20% of total IMF lending. So we're talking about quite a major development here that again hasn't been on the radar screen.
Sorry, sticking with just clarification.
Sure.
Rollover means what in the context of the swap exactly?
So every swap is a newly issued swap will be counted as one new loan.
Even
right?
if it's not drawn down? Let's say
No, we only look at, this is actually a novelty of this paper, that we're the first to track the actual usage of the swap line. Everybody else has just the total capacity or the total credit line, whereas we, for the first time, really pinned down the exact lending amounts, right? So this is the exact lending amount where we count every rollover as a new loan. Oftentimes these are 1 year and in effect 3-year operations. Right? So you might wonder, how do we get there? When the first paper we really passed together from a broad range of sources the various loans. You had information on energy loans, you had information on Asia Pacific loans, and we put everything together into this new data set and estimate these debt stocks, and this is where the hidden debt kind of insights came from. In recent years, we collaborate with 8data, which have really now kind of the gold standard in identifying not just lending, but also defaults, bailouts. They have, a whole large group of RAs, many of them Chinese language, natives. They scour all these documents, including in Chinese language, so embassy statements, annual reports of construction companies and banks. So they developed a whole methodology to trace exactly these flows, and we closely collaborate with Brad Parks now, and on this excellent work. In fact, maybe 8data is the best response to the Belt and Road initiative that the US has come up with. So funding 8data was a very good idea. I think just unveiling these flows, unveiling the terms of this lending was really highly influential for policy. Yeah, overall, they're now at 30,000 individual projects, loans, and grants. So they're expanding, also covering now advanced countries. So really highly recommended for you to visit their website, read their reports, if you're interested in this area. A second, this was secrecy. The second salient feature is that China seeks seniority vis-a-vis Western creditors, and it also seeks control over debtor countries, at least in the contract language they choose. So, anybody familiar with international debt renegotiations will be aware of the Paris Club rules. Now we have the common framework, which basically foresees that all creditors have to bear the same burden when there is a default, when there's a debt crisis, right? So there's burden sharing or comparability of treatment. China, however, as we uncovered in the original contracts, puts clauses into its lending that explicitly prohibit that kind of comparability of treatment, right? So it sees it writes into these contracts that these contracts are separate. The agreements are independent and separate from those stated agreements with other creditors, and it even explicitly states the Paris Club. So in these contracts, it is explicitly, evading or escaping the usual rules that we had been, working with over the past 10, 20, 30 years. What is also fascinating once you look into these contracts is how broad some of these clauses are, right? So creditors can trigger default in case of, non-payment. In these Chinese contracts, the Chinese state bank can trigger default at pretty much at discretion, at very vaguely defined events. So if any public entity of the Republic of Ecuador, right, any government agency or borrower takes any action which would disadvantage any PRC entity, the state bank can call default. What does that mean? Well, that the state bank has to be repaid in full and immediately, right? Which is, of course, a major threat. If you have received billions in infrastructure lending for a bridge or railway and you have to repay it immediately, that is, very hard for many of these countries. So this is, shows you the extent of control, of potential influence that these contracts carry. A third novelty, a third fascinating innovation of these contracts is that Chinese creditors demand extensive collateral. Let me quote you from one of the most famous papers in sovereign debt, Buller and Rogoff, stating that domestic loans are generally supported by substantial collateral, but the use of collateral in international sovereign debt markets is negligible, right? So this is the widely held belief is that collateral doesn't exist in international lending, in international sovereign debt markets. In a paper called How China Collateralizes, we identify that 50% of the whole Belt and Road Overseas Lending Program is in fact backed by collateral of some form or the other. We're talking about 450 billion in collateralized debt across the globe. So this is a really widespread phenomenon. Unless, what is often quoted in the press, however, we're not talking about collateral of, say, ports or specific infrastructure assets. No, on the contrary, China has come up with a much neater form of collateral, and that's cash. Cash in bank accounts in China. So how this works is that China Development Bank, for example, would extend a loan to the Ministry of Finance of Ecuador. This loan is backed by a bank account in China into which Petroecuador pours its revenues, pours part of its export revenue. So Ecuador receives commodity proceeds, receives export revenues, and say 5 or 10% of those revenues go straight to a bank account in China. So these are substantial ring-fenced government revenues that never arrive in the public budget. They go straight to China and serve as collateral to an underlying infrastructure project that is completely unrelated to Petroecuador, to the underlying provider of collateral, right? So this is, yeah, please.
Just
quick comment and question. The
Yeah.
U.S. Treasury had a similar arrangement with the ESF loan to Mexico in
Mm-hmm.
the mid-1990s, where the Mexican oil proceeds went to the New York Fed. But the question I had for on the 50% is collateralized,
Mm-hmm.
are the swaps in the denominator there, or that's only
That's not there.
only
No.
Exim and
No.
China Development Bank?
Exactly. Yeah, we have a footnote on that one in the paper. Yeah, maybe later. So unrelated means that the collateral does not come from the project itself. That's the blue bars here: project revenue and commodity sales. If this is a commodity company taking up the loan. Red means the red bars show you that the cash collateral underlying the loans really comes from unrelated sources, often from the main commodity exporter. So this would be kind of oil in Angola, copper in Congo, or gas in Indonesia, so the main, among the largest state-owned companies would back the loans that the country has received for unrelated infrastructure, right? So this is, and the size of these cash flows are very large. This is a sample of countries for which we know the actual scope and the volumes on these accounts, and we're talking about, on average, 20% of the total external debt that these countries owe, okay, that these countries are paying every year, okay? So 20% of external PPG debt service is what is laying in these accounts. So this is a large amount of money that countries basically have pledged as collateral, and that is passive laying there in a Chinese bank account. So again, a fascinating insight, an innovation of how China is trying to overcome these enforcement problems. A fourth insight, and this is from an ongoing project that we are conducting on the financial returns on the Belt and Road. So of course, there's a big question: what's in it for China? What's the financial return on this program? And since I was asked to talk about the political economy of it, let me highlight one interesting insight, and that is, we exploit now of 3,500 loans, we compute the financial returns, so internal rate of returns, the ex-ante returns of each of these loans, and then use the granularity of the data to identify, discrimination, if you want, right? So we can compare loan terms within the same debtor-creditor year cell. And what we find, and this is descriptive, that projects that have, that serve to project political influence in these countries, for example, for, financing what we call prestige project, financing parliamentary buildings or stadiums, that are helpful for politicians to be reelected, they get preferential terms. They have lower ex-ante return from a Chinese lender perspective, okay? The same goes to loans that go to the political leaders region or military security projects. The same goes also for trade infrastructure and public recipients. So China is, in that sense, positively discriminating for projects that are politically and militarily salient, and this is also true. This result holds once we control for year fixed effect, recipient fixed effect, creditor fixed effects. Finally, let me emphasize that China does not grant generous debt relief, at least so far. We've computed the haircuts, so the loss that Chinese creditor state entities suffer on these loans, and it's actually around 10% on average, which is much lower than the average haircut that external banks and bondholders faced in developing countries over the past 30 years, and even lower than what Paris Club, so Western government lenders, faced. We're talking there about 40 to 60% haircuts on average. So maybe this is just due to that we're just early in the lending boom and higher losses might yet come, but at least so far, they have really managed to not lose a lot of money on this large-scale lending program. And in fact, this is a default situation, that overhang situation, is one in which creditors might have the largest leverage over the debtor country. So there's also this political economy aspect in that regard, especially when you combine it with the view on what is in those contracts and all the strings attached that these have. So to conclude, China has become a global power in sovereign debt and infrastructure lending. It has unusual or robust lending practices along a whole range of dimensions. The net effect for developing countries is unclear. It remains uncertain at this point. They received important financing for critical infrastructure, but there's of course this large, debt service and debt distress challenge at the same time. So it's unclear what the net effect in the end will be. And let me finish on the general observation that what we see on China is part of a general trend towards a more opaque and fragmented international financial architecture. So I think we will see more of these challenges, more hard work to understand what is really going on in international financial lending with developing countries. Thank you so much.
Thanks, Christoph. So we have a number of hands up for questions. I also just wanted to ask one question. So just to start things off, so maybe a little naive, but I was sort of thinking, presumably we normally think about debt contracts as being sort of microfounded by some sort of optimal contracting considerations. It's one form financial contracts take versus equity. Which of those is preferred is going to depend upon the underlying sort of economic incentives. The fact that China's offering these contracts in a different form, it must either be because they perceive some benefit from offering a debt structured in a different way from other countries, or the person taking out the debt receives some benefit. And I'm wondering, why don't we see these contracts elsewhere if they're advantageous? Or what's different about China that's leading to this differential lending structure? Is this purely a political influence story, that it's because this is Chinese state lending, it's a non-market economy, and they're pursuing political objectives? You've hinted at that a little bit, and some of the results are consistent with that. But I was just wondering, should we be concerned about this? Why is this happening? Why don't we see similar things for other forms of sovereign lending?
And that's a whole number of really important questions. So I could probably answer for 2 hours now. But so maybe a couple of points. So we're not taking a normative stance on whether this is good or bad. I mean, one way to see this is that China has finally come up with, or at least attempts to overcome these long-standing commitment problems and enforcement problems that have plagued sovereign debt markets. And thanks to their legal and financial innovations, countries can now borrow more. They can, build up infrastructure that no other countries would have been able to provide them, right? So that's the more benign view. The more, the less benign view is that this is making, this is increasing the probability of debt distress. That this is a burden for debt crisis resolution, and this is actually on net a negative effect. I think the jury overall is out. Why does China only offer these packages? Well, I mean, I think one has to see it in the whole context of the Belt and Road, which is really, not just an infrastructure project, but it's, a market access, also a geopolitical project. And if you want to be part of this project, if you want to take part in the Belt and Road, you are offered a package. So you're basically more or less forced to take these loans, to take the financing along with the infrastructure, along with the management by Chinese company, along with the trade inputs and the workers from China, right? So China is offering a package, and I think the reason we are not seeing it, haven't seen it in other countries, that no other country had been rolling out a Belt and Road initiative. But we are already seeing signs that we are seeing kind of a collateral race, that we are seeing kind of race to the bottom or race to the top, however you judge it. But I could answer, for much longer, but this is just
We can
a short.
talk on the side afterwards as well. It'll be super interesting. Thanks very much, Christoph. Darryl, did you have a question?
You asked my question, so I'm set.
Okay. Emily, do you want to start?
Liz is way ahead of me.
Liz, go for it.
Yeah, so I'm just wondering, when you stopped your data collection, because I think there's been a shift in the mindset in China, actually, in the past couple of years. Even more than that, beginning with sort of Xi Jinping's statement about small is beautiful. Mm-hmm. And so a retargeting, because they don't consider what they are faced right now as a success, mm-hmm. right? So I think both in terms of the nature of the projects, right? So no more big parliamentary buildings and things like that. They're basically focused on minerals and clean energy and some important ports and things like that. But clean tech, they have like 3 priority areas. They're not really lending to Africa, right? So they're shifting where the money is going. And so I guess I'm just wondering, what's China's learning process? Because I think you put forth an argument that sounds like they think this is a success. But it's not clear to me that they think this is a success at this point, because I think there's been a lot of learning and a lot of shifting of priorities and structure. So maybe address that.
Sure. I mean, whether the Chinese think it's a success or not, I do not know. What I certainly see is a lot of innovation, from an academic point of view. So we've had, as I said, many previous lending booms, and so far China has been able to avoid some of the ugliest consequences that other creditors, Western creditors, have faced in similar situations. So, in a big historical perspective, I wouldn't see this as so far a major failure, right? So I think there are aspects of this where you see successful innovations, successful. China indeed has evolved, right? You see a shift also towards advanced economies, right? You see more lending in towards richer countries. This is fascinating. You've seen probably the eight data report, of course, and also a shift towards the net transfers you have seen, right? This has turned negative, so this is already a sign that they have stopped essentially giving out large-scale new loans. And again, this is an old story. It's something we've seen also in the early 80s. Net flows turned negative there as well, right? So again, and Western banks saw that same end of the cycle also as a failure in that sense. But I'm like, surely from their perspective, it might be a failure, but in the bigger scheme of things, so far at least, this looks more successful than the bust in many other historical settings has been, right? That write-downs has been much more modest than in previous.
Yeah, I mean, I think the point you made early on in your talk about we're just at the beginning, right, in terms of seeing how these countries are going to be able to respond to what China's going to face, I think is probably right. And I just think maybe looking forward, it's worth looking at more granularity at where the money is going, how much money is going, just to get a finer grained picture of the internal changes taking place in China in terms of how they're looking at this huge project.
Yeah, I mean, it's what's fascinating is that you always figure out only 3 years later, right? This is something that's really different from previous lending booms. I mean, the 70s was also not overly transparent, but at least everybody kind of knew where they stood. Now you need the next 8 data report to come out to figure out exactly the points you are raising. Of course, China expert might have additional insights, but the feedback I often get is that even the Chinese appreciate, this data collection that has been taking place in the West to understand where they stand. So I think that is really a difference.
Scientists, that's all you need. You just need some political scientists.
Thanks. So let me bring some people in who haven't asked the question yet. Philip, I think you had a question.
Historical comment. As a historian who is a student, actually, of how European lenders dealt with China and Latin America between, say, 1870 and 1914. I think Herbert Feist, Europe, the world's banker, for which there are many academic critics who decry that as a notable dimension of imperialism. This is 2.0. You understand the way that those lending systems worked and how the European lenders tried to collect. It's as if that record had been carefully understood and studied, and all the necessary refinements and improvements have been made. So that's interesting to note. Another interesting note, partly as a historical setting, is this is a secret network of financial arrangements with the preferences you described that is being created by China with its friends. How China is treating its less developed friends. Then the one prospective contemporary comment is we do have this little interesting case right now called Venezuela. I'd welcome any comment you may have. See, the United States has established what might one call an informal board of control over the finances of Venezuela at the moment, in which it is engaging in fairly interesting discussions about which I know little, but I can imagine, about what Venezuela will do with what money. And it's going to be doing this for some time. Well, the issue of Venezuelan debts to China and Venezuela's debt position generally as a fundamental prerequisite to any economic turnaround of Venezuela that might accompany a new government is obviously a base question. Therefore, the whole strategy of how you'd want to turn around Venezuela turns actually on the United States figuring out how to do a Chinese debt workout in cooperation with the Venezuelan government. And if you had any thoughts about the possible terms of such an arrangement, for example, an arrangement in which Venezuela might blame these bad debts on a bad dictatorial government, default on them entirely, have all that wiped out and be declared in default, but then work on the terms by which they re-enter international credit markets of course, they would not get any more lending from China, but they would try to develop terms in which they could enter other international credit markets. But since you've done so much work on this, I'd be grateful for your thoughts.
Yeah. Well, I fully agree with you on the historical analogy. We've had collateral before in history. We've just forgotten about it. I think one important difference, and again, I'm a little more positive in that sense, is that coming up with this cash collateral is really a great innovation, as you said, towards those old contracts, which, had strong wording but very little enforcement in these old lending contracts in the 19th century that you pointed out. On Venezuela, yes. I mean, when I started my dissertation, 20 years ago or so, China was nowhere to be seen in crisis resolution. Now you can't solve any debt distress, debt overhang situation in most of Africa, most of Latin America without, having to deal with these Chinese debts and trying to solve them. Venezuela has been long in default towards Western creditors. It has continued to service some of the Chinese debt. We don't know exactly. 8Data is working on also the time-stamped repayments, so we might know the exact transfers that are happening. We know that there were a lot of these commodity-linked repayments. Again, in history, we had many instances in which great powers forced countries to give more preferential. So we also see the return of selective default, in other words, right? So this is exactly what you say. How this turns out, is to be seen. China has pretty strong also, ties to these oil contracts. So in the end of the day, we don't know what's going to come out of this, but it's certainly fascinating to see,
Any precedent where a country has defaulted on its Chinese debt, but has then been able to re-enter other international credit markets?
I do think the answer is yes, because up until 4 years ago, we didn't know who was defaulting on Chinese debt. It was simply not known. So in that sense, it's almost certain that there has been some lending by commercial banks, at least, maybe not bondholders. But even that is possible, that you had some kind of arrears to Chinese loans that were just not public in the public eye, right? So I would say these classic rules that you would be excluded in default don't apply in the same way for China. And again, that's fascinating. Yeah.
Murray had a question.
Yeah, Bill Zellico anticipated a little bit my question, which is broader, but on the same theme. So the national security strategy that the administration put out envisions very intensive U.S. engagement in Latin America to the exclusion of other powers, by which they mostly meant China, but perhaps even others. So do you foresee that this could lead to disputes over, for example, debt seniority? Are new U.S. loans supposed to be senior to Chinese loans? How does the U.S. look at repayment of Chinese loans? Many Chinese loans are for green energy infrastructure. I think the U.S. would like Latin America to be safe for fossil fuels, not for real green energy. How does that feed into the potential conflicts?
The short answer is yes, I do expect that. I mean, at least under the current administration. We have to realize that China has been, on the receiving, it has benefited from preferential status, right? It has often been repaid due to these commodity-backed in-kind repayment forms. It has imposed relatively low haircuts. It has done these bilateral deals when other countries, were on board with Paris Club, imposed the same comparable treatment. So China has been, in a way, benefiting from better terms, suffering less losses. And as a minimum, I would expect the US enforcing the equal losses, and quite likely with this administration, I would expect higher losses and the return of these discriminatory practices that the US had already done in history, and the UK and other countries, right? So oftentimes after a couple of decades, these discriminations are eventually, worked out and kind of unraveled again. But often for 10, 20, 30 years, it can happen that, indeed, money to France is not being repaid, but there is a settlement with the US or with the UK, and I expect this exact thing could happen in Venezuela and in other countries in Latin America. Yes.
Okay, we've got a large number of questions. I'm intimidated about the ability to go around the room and include them all. But so let's keep going and try to do very quickly
Okay.
on response if possible. Glenn, do you want to go next?
Thank you, yes. Earlier this morning, we heard about the linearity or non-linearity of dollar dominance. Recently, a number of countries, including Zambia and Kenya, have redenominated their China-based loans from US dollars to renminbi in order to take advantage of interest rate differentials, but also partly as a Chinese strategy to expand the use of the renminbi in the larger sort of, international space. So I'm wondering if you can connect your data and findings to the larger project to build out the renminbi internationally, because it seems like there's potential here for China to insert the renminbi across the global south in ways that might not have been available otherwise.
Short answer, yes. We do see a tendency to more RMB lending. So the fresh lending it has a much higher share. It used to be 10%. Now it's more approaching 40, 50. That's at least what we see in the 8 data. And they are expanding these swap lines, which are also always in renminbi. So short answer is yes. I could answer more long, but
Okay, great, thank you.
Thank you. And Dara, looks like you do have a question.
Yeah, I do now. To what extent are these loans funding projects where the work is being done by Chinese contractors that have excess capacity in China, like China National Railways?
The exact numbers I can't give you, but this is part of the package. This is part of the whole initiative. I mean, there's disputes of how much of this can be explained by excess capacity, and again, this is not unheard of in history. So the US was exporting its highway technology, the British were exporting the railways and the telegraph. So, calling it excess capacity or just like technological advantages in construction and rolling out new technologies is, probably a matter of judgment.
Can I just say, it depends on the state, right? So different states have different capacity and negotiate different deals on the export of the labor. So some countries basically take the labor because they have weak state capacity. Other countries, say no to Chinese laborers. So there's significant variation across countries.
And then Brent, you had a question.
Yeah, I mean, I guess I was a little surprised in your initial reaction to Steve and Daryl's question, what's different about China? I guess a few things, my understanding I would have mentioned, and I wondered if you agree or think of it similarly or differently. But the first point is, historically, like after the multilateral debt restructuring initiative, a lot of countries like G7 countries kind of got out of the game anywhere near to this extent and shifted dramatically toward grant financing. And then two, at least when I was at Treasury, a really salient repercussion of a lot of what China was doing was building up basically achieved leverage via their role in the IMF's ability to continue programs with these debt-distressed countries, given the lending into official arrears policy that basically prevents the IMF from going ahead with the program if that country doesn't satisfactorily resolve its arrears to China. And of course, China is a major IMF member. I would have thought that one major difference that kept a lot of countries from operating in the same way is historically the multilateral pressure not to disrupt the system that we've all been working together to build. I guess I wondered if that's in line with how you view these issues, or if you had a different perspective.
I mean, I'm a bit skeptical of how much this lending into arrears policy is on paper and how much is on reality. So if you look at the history of arrears, at least according to the IDS database, arrears are everywhere and all the time. So the most visible and loud forms were maybe constrained this kind of IMF lending, but I wouldn't, and I would be highly skeptical of how good the arrears data with regard to China is. It's the best we have, but so in that sense, I'm not sure how much that has been a constraint even 20, 30 years ago, and how much it constrained China at the moment.
Just to note it, I do
Yeah.
have a lot of firsthand where I'd be across the table from
Yeah.
a country that couldn't move ahead
Yeah.
precisely because of some of the features that you were describing, and not talking about motives or anything like that, but clearly it conferred significant power to creditors that operated that way.
Interesting.
Thank you. And Emily had a question.
Yeah, so I would love to ask, this was very interesting, just for a little bit more insight on who is lending. You keep saying China, they, as if it is a single entity, a single lender. And I could be completely wrong about this, but I don't think I am. My understanding is there are a lot of different lending authorities in China, and it's been highly decentralized. And so when we think about who's been making some of these loans, especially the loans that have gone belly up in the early years, it's different from, say, some centralized government making a strategy about, here's where maybe we'll find leverage or we won't. Likewise, I think if we, again, imagine some of these decentralized loans being made, and maybe then, so in a sort of disaggregated fashion, and then the central authorities extending swap lines, maybe as a way to avoid large defaults in local, regional, municipal, provincial banks. That seems like a big part of the story that you didn't talk about. So I wonder if you could flag that. And is that possibly that mismatch between local lending and central strategy? Is that possibly part of what's going on, the decline in lending after 2019?
Yes. So excellent point. Yeah. Up to maybe 6, 7, 8 years ago, all you needed was the portfolio of CDB and Exim. They accounted for 60, 70%, right? Today, it's much more heterogeneous, but like the big lending boom that we've traced in our original first paper, I remain rather skeptical about this view that it's all very ad hoc and uncoordinated. At the end of the day, once you look at the contracts, there is a lot of overlap. There is a lot of commonality. Lenders differ in their terms. There is important heterogeneity. I don't want to, but at the end of the day, all of these banks report to, the central government, to the Communist Party, and you are very right that, of course, some of the smaller banks may have benefited overproportionally from these rescue operations, and that was, in fact, yet another similar story of the 1980s in the United States, right, where similar deals helped those smaller institutions afloat that had strong high levels of loans towards Brazil, Argentina, etc. So again, that's an old story. And again, this idea that you have large scale lending by many individual small banks, and then the central government steps in. That's exactly what we observe. But these bailouts haven't been, known, and you can really see that again makes it so similar to all these previous historical episodes.
Thanks. And Steve has a question.
Back to that point you made about secrecy. There are many potential motivations for secrecy, but one that I don't think you've mentioned yet, and I want to get your reaction to it, is that secrecy could facilitate self-dealing by the parties that are negotiating or implementing the lending agreement in the recipient countries in a way that serves their private interests, but is contrary to their country's national interest, and at the same time serves either China's national interest or those on the Chinese side who are conducting the negotiation. So it's, put it short, secrecy obviously undermines democratic accountability or any form of accountability, which you can imagine circumstances that could be manipulated. So is that part of the story here behind secrecy, or is that just not it at all?
I do think of much of the terms, much of the approach they are taking is just mimicking what they do internally. And I think they are not very transparent internally either. So I think that's one logical explanation why. The other is, the Paris Club clause shows this, that they don't want to be thrown in the same pot as Western creditors. They want to, continue their bilateral agreements. They want to restructure the debt out of public view. There's a lot of research on IMF conditionality because that's public. We know what the IMF demands. We have no idea about the political and geopolitical conditionality of some of these loans, right? And the secrecy helps there, right? So if the financial returns on this, just the mere, is just 1.7% on average, so there must be some return beyond the mere financial returns, and you could look at also the trade integration returns, but there are ulterior motives beyond that, and secrecy helps for those.
Well, nothing. There could be multiple motives. So all the motives you just described make sense. But is there some reason to think that the motive I described is not part of the mix?
No, I mean we don't. At the end of the day, we don't know, and that's definitely also a possibility. Yeah, I agree.
And Robin had a question.
Thanks for just this enormously valuable data and tracking. I just wanted to mention, one question about all of this is, why do other creditors let China get away with this, meaning other bilateral creditors? And my answer would be, they've started to fight back.
Yes.
We were involved in that effort. So I don't know if you can pull up the slide on the haircuts that China took.
Mm-hmm. Yeah, I actually have a comparison one that you might find even more interesting.
So basically, in the wake of COVID and with the common framework, the big restructurings were Zambia, Sri Lanka, which was outside of the common framework, which is a middle-income country, Ghana, and those were all instances in which there were, long public debates that involved mobilizing Paris Club creditors not to accept situations in which China received a sweeter deal than other creditors. And so to Liz's point about how have Chinese lending practices changed, one influence is probably their own experience in domestic political economy. But another element of it is how the other creditors that are being disadvantaged by the way that China was going about doing business have responded. And so it will be interesting to see how, I would be interested in the evolution of these clauses over time, and China's ability to enforce these clauses over time, because there are checks in the system against that. And by the way, I'm not spiking the football and saying that that the situation is good. China certainly prevented more dramatic debt restructurings, NPV reductions than otherwise may have been desirable because they were such a large creditor. But the kind of going along with China's, sweetheart treatment is something that there was a considerable amount of pushback, at the end of the period that you're studying.
I fully agree. I think we have seen pushback. I wouldn't call victory, though. Just because we had Zambia and a few other cases with somewhat higher haircuts, this just compares using the exact same methodological approach, the haircuts that the Paris Club creditors took and the haircuts that China took, and you see that there's even if you add Zambia there, which is not yet in the picture, they have way to go to achieve similar levels of debt relief, and also on those lending operations, on those loans that we have knowledge on, we can be tougher. But as the recent 8 data report states, China's overseas lending program is going dark. It's going, towards ever more via offshore, ever more shell companies. So we might again miss a lot of the action, and if some of these, loan operations. So we don't even know how deep the collapse in the actual lending is, right? The known amounts have really collapsed completely, right? But maybe there's much more than we know because it has gone in these shadow channels. So China's also kind of reacting, if you want, to our pushback in that sense. And so in those countries where the debts are known, the problems are known, I would agree with you that the times of sweeter deals are harder for China. But it might just a new generation of deals, a new generation of this lending and crisis resolution may lay ahead. It's an ongoing cat and mouse game, I would say.
I think there was another chart you had on haircuts, I think, that showed
Yeah, this is just the historical comparison, but it shows the
relevant
same.
comparison would be looking at recent restructurings.
Yeah.
Chinese creditors taken bigger or smaller haircuts
Yeah.
than other creditors. In general, the earlier waves of debt restructuring were much larger.
Yeah, yeah, yeah.
Okay,
There's a lot of extend and pretend going on.
thank you. So we're getting really tight on time. So I'd suggest we kind of collect questions together, ask a bunch of questions, and then you reply in the remaining time available. So, Chris, do you want to go next?
Sure, this is really fascinating, a lot of questions. My question was about the borrowers and kind of make it seem like China's like this rapacious lender with weird terms and conditions, but there's a lot of liability that these borrowers have. Things that people already mentioned. They're undemocratic, they're not accountable, there's not transparency, a lot of odious debt here. I'd like to hear more about that, and it kind of has implications for like what the long-term end game is. Like how far could this go if you can only lend to certain types?
And then Patrick has a question.
Yeah, I was interested to hear, again, a bit more about who's doing the lending. So a kind of observation would be China is organizing its financial system to do different geopolitical tasks. So there's a set of banks led by the two, Exim and Development Bank, that are doing the kind of dirty-ish politicized lending. There is a set of banks that's doing sanctions busting. There's a set of banks, ICBC and Bank of China, that have American licenses and deal in the dollar system. There's the AIOB, which is the pretend multilateral bank. So perhaps you could talk about whether that sort of pattern of China organizing its financial system to do different geopolitical tasks, is that what you've found, or is there a different, more random setup?
I think Ralph has a question.
I just have a very quick question. The name, the Belt and Road Initiative, suggests that there's a geographic component, and I've always tried to figure out what that geographic component is, whether there's some trading corridors that are being built or anything of that sort. But given the opaqueness, I always found that very difficult. So I was just wondering if you have any more insight on that.
Brent, do you have another question or no? Okay, good. Okay, great. So, Christoph, do you want to take a few minutes and respond to those last questions?
Thanks so much. So yes, China has been lending to countries that where the lowest credit ratings, where the lowest institutional capacity. In fact, to countries where no other lender was willing to go and extend that kind of large-scale loans. But I think you're right. They are adapting and they are climbing up the ladder, if you want. They are so they are not constrained to that set of countries. And I think in that sense, that's where they started. That's how they kind of also gained, I think, a lot of leverage in African countries, in Latin American countries that previously and without the Belt and Road and this lending program they wouldn't have had. But I don't think they're constrained to that, and it's I think they remain rather open of who can take part in this, right? Again, the latest 8 data report showed just how much advanced countries have been borrowing from them. More than 1 trillion, again. So this seems to be a larger part now than the developing country lending. So again, this is a moving animal. And this is also, an answer to your question, which was excellent, right? So indeed, we shouldn't forget that China is also a major creditor to the West via bond holdings of the central banks, right? So that's massive, and much larger than, in fact, the developing country lending. They also have the sovereign wealth fund. You've mentioned, the various other instruments. How strategic and how all these pieces fit together, and that there's like a central brain behind all of these pieces, I do not know. It's hard to say, but there's certainly like a lot of experimentation, and some more, some less successful, but that's definitely to keep in mind, and that's what makes it so hard to track also, right? But there's definitely one common theme, and it is like a very heavy role of the state, right? In all of these activities. I think our classic models of portfolio optimizing investment just don't fit what is going on there, and that to some oftentimes really I think we face major challenges just interpreting this, because then it gets shrouded in all this geopolitical we don't know cloud, and that makes it very hard to understand. BRI, I mean, the name has changed 4 times over the past 20 years. My sense is that they don't have any definitional constraints of who can be a BRI country, and it's to some degree vague concept. It's more of an idea than a specific regional program. I mean, when you look at the bailouts, in a way, it's a regional bailout program that is more reminiscent to the ESM, European lenders bailing out their periphery. It's of course a very different geography, but it's that sense. It's certain regions, it's certain countries that have been particularly tied in. Mostly, the poorer countries. Yeah.
Terrific. Well, that was another fantastic session. Lots of discussion and questions, which is terrific. We're going to take a 15-minute break now, and then Matteo is going to take over for the last 2 sessions.